Hello, good morning, good afternoon, good evening, depending on where you are in the world. I'm Nicolas Véron. It's my pleasure to introduce this session of the Financial Statement Series at the Peterson Institute. As some of the more eagle-eyed among you may have noticed, this is our first session in April, so just in time. We skipped one beat earlier this month, but that was for force majeure reasons, but we'll resume our normal pace of 2 sessions a month from now. It's my very great pleasure to have this session today with Katharine Braddick and Doug Rediker. Katharine is, of course, the Director General of Financial Services at the United Kingdom Treasury, which is Her Majesty's Treasury in the traditional parlance. She has been there since 2014. After a distinguished career in civil service, she studied at Warwick and at Cambridge, where she got her Master of Philosophy in, I think, medieval Italian or Tuscan in 1996. That's very relevant to financial services, as any student of financial history knows. Then she entered the civil service. She was at the Department of Environment and Transport. She took a 2 years break at the Association of British Insurers in the early 2000s, and was at the Financial Services Authority, head of banking policies, the Prudential Regulation Authority at the Bank of England, as director of prudential policies. That was the early 2010s. And then, as I said, since 2014 at the Treasury as director, and then director general since 2016 of financial services. So she is a point person for all financial services policy questions inside the UK government. And therefore, I cannot think of a better person to discuss our topic today from that perspective. Doug Rediker started his career in law and then in investment banking. He's worked at a number of the most reputable and famous investment banks. He joined the think tank world in, I think, 2007 at the New America Foundation, where he co-founded the Global Strategic Finance Initiative. And then he worked for the Obama administration. He was also, I think, associated in the Obama campaign. Between 2010 and 2012, he was a member of the IMF, the International Monetary Fund's Executive Board, representing the United States government. After that, very importantly, he was a fellow at the Peterson Institute for International Economics, and that's been between 2012 and 2016, with fond memories from that period. I'm referring to my memories. I hope that's also true of Doug. He has also founded and is the chairman of a consultancy called International Capital Strategies LLC. Very experienced observer of our topic. I should mention that Doug, for a number of years, was based in London in his time as an investment banker. So on that note, enough for my introductions, and over to you, Katharine.
Thank you so much, Nicolas, and thank you for inviting me today. I'm going to talk a little bit about how we see our situation having left the European Union from the UK with respect to financial services, but as much as anything, I'm going to talk about our future direction and the drivers that are informing our policy making. I should apologise that I have a slight cough and cold, so I will use my mute not to inflict that on you as far as possible, but my apologies for that. And it's also why I'll be drinking this cup of tea throughout my attendance this afternoon. That's not just because I'm incredibly British, it is actually because it's helping my throat. The very significant shift on the 1st of January as we left the European Union was not for our financial services industry a huge shock or adjustment. It was an industry that was already very well prepared for a no equivalence deal with the European Union. Indeed, the industry had been preparing for that outcome virtually since the referendum results in 2016. That situation, leaving the Union with certainly, fortunately, with a deal, but without material equivalence decisions in place from the other side, was certainly not the outcome that we had wanted. It's not the outcome we sought to achieve. We had, as I think is well known from the UK government perspective, been advocating for having pretty comprehensive findings of equivalence in place going in both directions in advance of our departure, for the purposes of supporting the degree of interconnectedness and trade that there is between our two jurisdictions. However, we're fortunate in having effective regulators and in having thoughtful firms, and so they were prepared for the alternative outcome, which is where we find ourselves. So far, we have not seen the sort of scale of shift of activity out of the UK that was predicted, certainly widely predicted, in the summer of 2016. There hasn't been an enormous amount of change in the overall employment pattern in the UK financial services industry. A lot of the change that we have seen, the shrinkage that we have seen, is as much as anything correlated with overall the picture on profits and a drive to optimise for cost in view of profitability in general, particularly in investment banking. And of course, the notable exception is the change delivered through the application of the share trading obligation. But by and large, you know, we're seeing restructuring. We haven't seen massive relocation, but we are under no illusions here in the UK that we are not at the steady state in terms of the distribution of activity through Europe in financial services in the wake of our departure. The drivers for that are continuing drive to optimize for cost. Firms are under profitability pressure, and they are working hard to ensure that in what is quite often for them now currently a low profit region in Europe, that they are running that as efficiently as possible. And where costs arising from Brexit play into that, we expect to see that taken into account. We also, of course, see regulatory pressure from the European Union for banks from the ECB, and that's within the context of a stated agenda for strategic autonomy in relation to financial services, which is currently, and we may get into this in discussion, extensively discussed. Only in a few areas are we really starting to see what that could mean. But one of those areas and the third driver for change in the industry, potentially and dangerously in my view, is around clearing. The question of the operation of CCPs and the clearing of euro-denominated instruments has been it's been highly contentious and not just, or even not primarily, a technical question for some time in the region of Europe in the wake of the financial crisis and the role that clearing played at some points there and in the sovereign crisis. We have a temporary equivalence finding for clearing, but there is already concern in the industry about its extension and any attempt to force relocation of clearing into the European Union, with implications for cost, but also very seriously potentially for financial stability. So there's a lot still in play. Those are some pretty serious issues. And we are very alive to them and focus on them very closely. The consequence for the UK of our departure from the European Union, however, does differ somewhat from the challenge that faces the European Commission and European policymakers, because the UK's withdrawal significantly alters the nature of the single market in financial services. We in the UK have a very similar market to the one we had before, and we have the same interests that we had before, which is to ensure its stability, to ensure its competitiveness, and to retain global leadership in financial services. We therefore don't need to rethink our overall purpose, but we are very keenly aware that we do need to re-establish a sense of clear and consistent values and direction in the way we make policy and regulate around financial services. That's not to indicate that there's been any disruption to that per se, particularly in terms of regulation, but the Brexit experience has been seen as disruptive and concerning in industry because it threatens predictability, which is important for long-running business decision-making, fairly obviously. So what are the values that we continue to progress and seek to shore up through our policy making. They are, I think, quite consistent with one exception that I'll come to, with the values that we had on the eve of the referendum. We believe in openness in financial services. We believe openness benefits the global financial system. We believe in high regulatory standards, not least to protect citizens and our economy from the consequences of housing a large, complex international financial centre. We believe in maintaining a really competitive environment for financial services in order to retain what is for us a very important area of productivity and exports. And we believe that we do that through having really highly effective regulation, but also fostering innovation. And I think now, and this is the new bit, we see a very important set of goals around supporting governments' agendas for climate change and the environment through the delivery of finance. So if you look at what we say about COP26 and in our G7 presidency, a lot of that is about bringing finance into the mainstream of achieving climate and environment goals, and we may talk about that a bit further. But it's one thing to state the values. The thing we're very clear about is that we will be judged by the actions and not the words. So we are just in the process of finalising the passage through Parliament of a financial services bill, quite a small bill, but it exhibits, signals direction on some of these areas, in particular by establishing a regime for the authorisation of overseas funds here in the UK, delivering our the powers for us to implement Basel 3.1 in the UK as previously committed. But the other actions that I think indicate direction are commissioning Lord Hill, of course, our last EU Commissioner for Financial Services. Those were the days, to do a review of our listings regime to ensure that it is as effective as possible for supporting public markets and the concentration of public markets in the UK. A review of the operation of the overseas persons exemption, which is one of the key means by which businesses can locate in the UK but reach the rest of the world. A set of measures around climate and environment, a commitment on TCFD disclosures, on establishing a taxonomy, on issuing a green gilt. And in tech, we're seeking to lead from the front in thinking on, for example, central bank digital currency and the use of DLT, including in potentially in financial market infrastructures.
I think that
looking forward,
DLT stands for distributed ledger technology, right?
My apologies, yes.
And I always forget what TCFD stands for.
It's the Task Force on Climate-Related Financial Disclosures.
That's right. Thank you.
Which I'm very proud of being able to remember, because it's actually not a very accurate acronym for the thing that it's describing. My apologies for the acronyms. I do apologise. Looking forward, I think we will see some larger pieces of work as we seek to, now that we have complete control of our rulebook, to tailor it more closely to the requirements of our market, which we're now able to do. We can make the rulebook work for one and not for 28. And we've already launched a review of Solvency II. And you may have noticed that we have announced the intention to review the wholesale markets regime in a way that I think is probably similar in its purpose, although I have no idea whether it's similar in outcome to the work that the Commission will do on MiFID, because it's effectively the same thing. It's saying we have this very large piece of reform and we now need to establish whether it's worked as intended for our markets. We also will do a very developed and very important piece of work, although it sounds rather esoteric, on our regulatory framework. As we leave the European Union, we leave the established rulemaking and legislative structure for financial services standards. So we will no longer be negotiating in council for level 1 text that is then delivered by regulators through level 2 text that they negotiate. We have to re-establish the roles and accountabilities for the different levels and kinds of rulemaking in the UK. And as I say, that sounds rather esoteric, but in fact I think will be a very complex and developed debate in the UK. We've seen a little bit of it on the Financial Services Bill as our parliamentarians begin to wrestle with the question of who is responsible for the way these requirements actually affect the economy and our citizens and households and businesses. And then finally, we're doing a lot of work to continue to develop our relationship with other jurisdictions beyond the EU. Perhaps the most ambitious and innovative of those is our intention to conclude a mutual recognition agreement with the Swiss, which is the most ambitious attempt of its kind to foster cross-border financial services trade bilaterally. I'll conclude with two observations about what I've just said. One is, you'll observe that at no point have I said that an objective is to converge or diverge with EU policy, and that's because it isn't. This is not a question about convergence or divergence. This is a question about how we manage our obligations, how we use our levers to support our goals. The question of the extent to which that aligns us with or takes us away from our European partners will then emerge as we begin to work out what the optimal answer to some of those questions is. But I think it's important to say that either convergence or divergence is not an end in itself in terms of the way we're thinking about our policy making. The second is that in all of this, the international context and international cooperation and standard setting is absolutely critical, and particularly in these relatively new areas of technology and the environment. Problems and risks that don't recognise borders, but also whose solutions cannot be addressed on a jurisdiction by jurisdiction basis. And so we will continue to regard it as critical to operate within an international standard setting community to deliver these goals. The future, therefore, for us, I think, is as a continuing to make the case for ourselves as a regional hub to reach other parts of the world through tech-enabled provision of services and through intellectual leadership in the drivers that are most affecting the way financial services are currently developing and being delivered. And I think I had my stopwatch on because Nicola was very severe about the time. I think that is about 10 minutes, so I'll stop there.
Thank you so much, and this was superb. You covered a lot of ground, and I certainly have lots of questions. But first, Doug.
Thank you, and it is an honor, of course, to be back with my old Peterson colleagues. So thank you, Nicholas, for the opportunity. Let me start by citing the need to draw a distinction between the impact of Brexit on the overall global financial services sector, market liquidity, market functioning, individual institutions, and the rest, as opposed to the damage to the UK City of London, the British government, and British private interests. The former impacts are more diffuse, flexible, and potentially able to retrench. The latter are narrower in terms of specific impacts. Now, it was made pretty clear early on in the Brexit negotiations that neither the UK nor the EU were terribly receptive to the arguments that the UK financial services sector needed to be a high priority. And most of us assumed the UK government would place a much higher premium on advancing the interests of the city, given that it represents around 7% of UK GDP and about 10% of its tax revenues. But instead, during the negotiations, for a variety of political reasons, financial services were, if anything, underemphasized. And many bankers I spoke with were ultimately grumbling they felt very unloved. And especially as the final talks appeared to be in jeopardy on the basis of the dispute over fish and not financial services, there was a real sense that the financial sector felt that their interests were being subordinated, at least certainly relative to expectations. So where are we now? Well, you just heard that from Katharine, but I think even the relatively modest chipping away of London's preeminence that we've seen so far is going to have an impact on things like the UK tax base, financial stability, risk, fragmentation, the ability for the UK to impact global regulatory regimes, strategic and transactional relationships with the big actors around the world, including China, Russia, and there are a lot of other geopolitical considerations as well. So what's going to happen post-COVID? Because I think most of the impact of Brexit has thus far been overwhelmed by COVID. And once the crisis is finally behind us, there's going to be a real question about whether the fairly modest job losses we've seen so far accelerate. Now, so far, we've seen that many banks have opted for models where their front offices are relying on local hires for client-facing businesses from Madrid to Milan and beyond. But what happens if bigger chunks of the business leave the UK? And in particular, if back office operations, and Katharine mentioned this, including clearing, but also settlement, risk management, and other parts of the business leave the UK for the EU. And it seems inevitable to me that the SSM, the single supervisory mechanism, so we don't use acronyms that are not fully defined, at the ECB, it seems inevitable that the SSM is going to increasingly seek to bring risk management under their control. Now, earlier this year, we saw the vast majority of EU equity trading quickly moving from London to Amsterdam. And while this was easily foreseen, it still caused a stir, in part because it happened so quickly and easily. And in and of itself, it didn't create a huge impact of employment, but it did poke a big hole in the story that London could never be replaced. Now, equities are different than other markets, and some markets will be harder to move, especially those where deep liquidity is required. But it was still a warning signal that caused some complacency to be shaken. Now, the key is going to be derivatives trading. There's temporary equivalence given for now, so it's staying in the UK. And of course, the UK government and financial actors and banks want it to stay there. And they argue that keeping it in the UK promotes efficiency. And they argue if it ain't broke, don't fix it. But EU regulators are concerned with what would happen in a crisis. And they worry about how safe they would be with so much financial stability risk residing outside the EU borders in what is now a third country. While there is definitely trust and general agreement with the current set of players and rules, there's also an acknowledgement in the EU that in a crisis, countries inevitably look after their own interests, regardless of what was agreed upon in some form of plans pre-agreed before the crisis. And what we've repeatedly seen is that national interests often trump multinational commitments. For example, during the early phases of the COVID pandemic, plans for how to tackle the pandemic were widely ignored in favor of more parochial interests. Also, in a crisis, technical experts often get replaced by politicians, and there is a lot less trust and expertise at that level, where those individuals are more prone to make narrower, politically motivated decisions. So that leaves the EU with a very delicate balancing act between financial stability risks and the cost of market fragmentation. Now, the EU argues that its financial sector is now better to innovate and modernize its markets to take advantage of fast-changing global markets, especially in terms of digital finance, fintech, green initiatives. And the UK political rhetoric is all about freeing the UK from the shackles of EU regulatory oversight in these areas. And the UK is now likely to take full advantage of the new opportunities in finance, as they'll be able to move more quickly to modify their level 1 framework and allow agencies to operate more flexibly. And this is going to be a big problem for the EU, because in the EU, the rules are much more specific and codified at that level 1, which is a feature of how the EU is simply structured. The EU is going to have a lot of trouble adapting their rules to handle the new areas of finance, including digital, fintech, green, et cetera. But the EU isn't likely to sit back and allow themselves to be left behind and suddenly find themselves subject to greater third-party risk to their own financial stability. So the EU is likely to try to recoup some of the derivatives business, which leads to risks that the UK could respond in a way that triggers a breakdown in that trust and creates a vicious cycle and greater divergence. Let me just finalize by my last point by making the point that both our previous speaker, Katharine, and Lord Hill, and the Chancellor and others have focused specifically on the UK financial sector's ability to focus on competitiveness and emphasize its overall attractiveness for doing business. And while competitiveness seems like a good thing, by emphasizing the need to liberalize listing requirements, open up markets further to retail investors, create different governance structures, the UK is potentially increasing financial stability risks. While they are free to do so for their own financial institutions and residents, the EU has a legitimate concern about what that means for its financial institutions and investors. So while there's clearly a great deal of trust and confidence in the UK regulatory regime today, there is a question about how long that is going to stay in place. The UK is a medium-sized country, even if it remains a big financial player. But in a world increasingly at risk of decoupling and fragmentation, especially seeing the tensions between the US and China, not to mention long-standing questionable but wealthy and liquid actors from Russia and the Middle East, there's a legitimate concern about how the UK is going to operate in potentially at risk of lowering standards to maintain that competitiveness advantage to attract finance, investment, and capital to the UK from China, Russia, and the Middle East. One of the consequences of leaving the EU, the UK will find it's harder to punch above its weight without the EU alongside in dealing with these geopolitical and strategic questions. So I'll leave it there.
Big questions here. Before I give the floor back to Katharine, and we already have questions from the floor, so I will ask her to be relatively brief in her response. Just both of you alluded to level 1, level 2, and I'm not sure all our audience are familiar with this. So Katharine, if you can also maybe highlight the difference between that and what in the US, for example, would be called legislation and regulation.
Yeah, so well, and I don't understand the US system well enough to draw the parallel there, but essentially it's a distinction between legislation made that's intended to capture the overall strategic purpose of any piece of regulation, and which in the EU system is agreed between governments, and then regulation that is intended to capture the technical detail of how firms should comply, which in the EU system is negotiated between regulators and put into what are called level 2 regulations. So in the UK, the terms are primary and secondary legislation. Primary legislation has to be made through Parliament by the government. Secondary legislation can be made by the government, but actually in our system, regulator rules have the status of secondary legislation. So there's it's a question, it's partly a question about accountability, but it's also clearly a question about agility, because secondary legislation is faster and more adaptive than primary. I hope that helps.
So any quick reaction on Doug's remarks?
So I think, so the first thing, 3 things, I won't attempt to cover all of it. The first is that there's a sort of collective fantasy between regulators and policymakers that we decide where business locates, but we don't. Not even actually company boards decide where business locates. Clients decide where business locates, and that will certainly that's certainly been the case so far on clearing, and I think we will see it continue to be the case in investment banking. So, and frankly, you can see that in the way the industry restructured itself ran ahead of the public debate and the negotiation by at some points, some months. I think one of the things also that occurred to me as Doug was talking is this sort of collection of objectives that could be in tension for the union and its institutions between wanting control over risk versus wanting control over the institutions that provide support into your economy, so the actual function of the financial services sector, versus a kind of a set of what I would regard as narrower goals to do with just getting jobs and tax revenue from the sector. And in fact, achieving those, you can't achieve all 3 of those. They are directly in tension. And in particular, I think Doug's pointing, or perhaps I'm putting words in your mouth, but I think there is certainly a question about how you want the most efficient funding for your economy versus where you want, which institutions you want to get that funding from and their connection, their ability to connect with the rest of the world. Finally, on standards, I take the point about concern about if you like, sort of political and economic pressure on independent regulators to regulate in a way that delivers broader economic objectives. And that goes really fundamentally to the heart of this future regulatory framework work we currently and will continue to have in regulators completely independent of government, but quite how that works and how the accountability that is considered acceptable by parliamentarians and citizens, I think, is now going to be quite an interesting discussion, not least in the context of this question about the UK's future approach on regulation. But fundamentally, we have a huge financial services sector, and strong regulation is therefore in our economic interest.
We already have a number of questions in the Q&A. I will start with one which, well, I encourage, of course, our audience to ask more questions. I will sort them out. I'll start with one which in a way is a hook for a broader debate, asked by Greg Smith. Will other destinations in EU like Amsterdam be able to give great financial services as was the case with London? Katharine, how do you see that issue of competition with EU financial centres at this point?
So I think I think I have nothing novel to add that anybody in the industry would not identify, which is what you see emerging in the EU as this business has bifurcated, is the emergence of 2 or 3 hubs rather than one concentration. Amsterdam is one, Frankfurt is another, and they're developing their own specializations. The question about whether they achieve critical mass is less to do with even to do with specifically those regions than it is to do with some much broader policy questions about how you might achieve CMU and how you might achieve this sort of strategic autonomy goal. But at the moment,
it's Capital Markets Union, right?
Capital Markets Union. Yeah, sorry, you did. I should explain to attendees that Nicola gave also a very stern warning about acronyms, which I've now fallen over on 3 occasions.
I always succumb to the temptation of playing the acronym police.
I'm so it's an appalling habit. I'm so sorry. So I think you see a sort of octopus mode emerging, sort of 8 brains and 3 hearts kind of model, rather than the concentration we see in the UK.
Yeah, can I just chime in, Nicola, just to say, I do think London's going to remain the preeminent European financial hub. But clearly, as I think I mentioned, you're seeing a lot of front office business move closer to the clients. And when I was a banker before the euro in Europe, you know, you had Italian bankers doing business in Italy. You had French bankers doing business in France. Then it all sort of became much more centralized. And now it's sort of becoming more diffuse, back with the front office, moving back closer to the client-facing interaction. But I do think you're going to see more jobs in banking move to Frankfurt, you know, in the asset management business, more jobs moving maybe to Dublin. I mean, there'll be some diffusion, but I don't think there's going to be anything that ever replaces London in the European context as a financial center.
So Doug is making this distinction between front office and back office, and he also mentioned before that the European Central Bank, in its capacity as a banking supervisor, may push banks for bringing more risk management and other back office functions or middle office into the Eurozone. Katharine, can you give us any sense of what you're observing in terms of supervisory action in that space and the pace of it also? Yeah,
so indirectly, yes. You know, what I can see is that European authorities are interested in what they, I think, would describe as the movement of risk to sort of a geography within their reach, and I think they are interpreting that quite widely, and that, you know, that's not a sort of infinitely extendable policy, in that there comes a point where the pressure to relocate business actually rubs up against objectives of our own regulators to do with best execution and to do with business model effects and many other supervisory concerns that they have. So I think this is relatively dynamic, in that there's quite a lot of pressure to move quite a lot quite quickly, and for firms, this is, you know, what I hear from the industry, and others on the call may tell me otherwise, and that is, you know, that's very much at the sharp end of where we're seeing this new border arise. I think the supervisors are feeling the border to a greater extent than the policymakers, if I could put it that way.
So when you say rather quickly, it means it hasn't happened yet, right? So the ECB in this discussion is still in transition mode.
Well, I think they've been talking to firms for some time. I gather they've been talking to firms for some time about the kind of business they want to see located within the union, within the EEA more particularly, and they've been asking for quite concrete plans, and they've been holding firms to the pace for executing those plans. So in that sense, I think we're already in it, but recognizing that it takes time for execution, but also I think firms have differing views about whether that's the best, safest thing to do for their business. But you know, I'm not in the room for any of these discussions, and in a sense, I'm a spectator to this. But that's what I hear reported.
None of us are in the room where it happens, but it's an important room. We have a question from Seljuk, and by the way, our audience probably knows it, but the EEA is the European Economic Area in that context, so the single market. We have a question from Seljuk Gokuluk, who is asking, what is the UK doing to attract more emerging market transactions, foreign exchange trade, Eurobond issuances, initial public offerings to London? Is there more focus on emerging markets since Brexit? Can you give examples of steps taken?
So is there more focus on emerging markets? I don't know. I think there is more focus on third countries altogether since the referendum vote, so rather than since January. And we have a challenge of trying to drink from a fire hose here, in that we could be talking to absolutely everybody all the time, but we also have we have to sort of concentrate our resource to those areas where it's going to be most effective. And I say that because, as well as the financial dialogues that we have that are really very developed, into which we give a good deal of resource with, for example, India, China, Brazil, where we do a lot to try and foster cross-border trade in financial services with a certain amount of success. We also are pursuing quite a broad range of free trade agreements and our accession to the CPTPP. So it's a incredibly broad waterfront, and I think that the risk for us is that we do a lot of window dressing that doesn't actually achieve very much. Our work in this area tends to be very heavily driven by industry. So I could sit at my desk, which is sort of metaphorically in Whitehall, but actually, as you can see, in West London, but I can sit at my desk and invent a series of things to do that I would quite enjoy, that would involve sort of talking about cross-border trade with various jurisdictions, but they would actually achieve very little because they're not being driven by the commercial reality. So we have also set up a set of trade advisory groups for different jurisdictions, so that we can get advice from industry about, you know, if we're going to devote resource to removing a block, which are the ones that would then deliver the most business. And that's the way we go about trying to focus our activities. And we are concentrating on, I think, the jurisdictions you would expect us to concentrate on, and the industry is pushing us very, very heavily towards Asia and the Asia story, because that's where the growth is.
Well, there's one jurisdiction that certainly carries a lot of weight in that concern, which is China. Can you give us a little bit more of a sense of where the UK stands in terms of, you know, being the gateway for China to China? We all remember the rhetoric of a few years ago. It's a slightly different situation now. What is the current landscape here?
We continue to, we have, and throughout the recent period, have continued to work closely with counterparts in China to foster trade, and it continues to be our goal to be the partner of choice in this geography for internationalization of the renminbi, but for finance more generally for Chinese interests. And a lot of it is kind of quite long run investment in pursuing the licensing interests or other interests of particular firms who can then act as kind of pathfinders for other UK firms. So we just continue to push that ahead and continue to have actually very cooperative, constructive and collaborative relationships with Chinese counterparts in financial services, I'm very happy to say.
Doug, you look a lot at emerging markets. How do you look at these issues?
Well, all right. So first of all, I come at this from a background where in a previous life, I was an emerging markets banker in London under a much different regulatory regime, and certainly where the UK leaving the EU was never anything anybody contemplated. But I say that because I sort of come at it from the perspective of someone who was a banker who at the time advocated for a much less stringent regulatory regime, because it was in fact in the industry's interest to attract as much business as we could. And there was nothing wrong with that. It's just my agenda as a banker seeking to raise capital for emerging market companies on markets based in London was that agenda. That was it. Now I take a sort of a different perspective, and especially after the global financial crisis, we can all look back and say, what were we thinking in some areas, not all. And that goes back to the point I made earlier about the emphasis on the commercial side of this and the competitiveness side of this, and the concern that I have, which is that in order to attract more business, inevitably under the pressure of the industry in an otherwise benign environment, you say, well, sure, why wouldn't we lighten the regulatory requirements for listing here, or loosen the governance restrictions for listing there? And it makes all sense in the world until there's a catalyst for somebody to take a step back and there's a crisis or a quasi-crisis, which forces everybody to say, what were we thinking? I'm not saying that is what the UK is doing. I'm saying that's simply the risk. And when we talk about emerging markets, and when we talk about China in particular, as your question was, you know, let's just draw a distinction between what's going on in the US right now. And I'm not saying the US is correct or incorrect. I'm just saying draw the distinction, where there's a huge effort here in the US to limit Chinese access to US capital through the markets over concerns over transparency, over concerns over disclosure, over governance concerns where audits are not being allowed that are consistent with US law. Therefore, there's a rule now that says within X years, Chinese companies are not going to be able to raise money in the US unless they comply with these basic transparency and disclosure requirements.
I think the point about audits is not that they're not allowed, but that the working papers cannot be inspected by the US regulator, right?
Well, that's right. That's right. But that just the directional shift of that is to be more wary of and cautious of that initiative. And as we just heard, the UK is not necessarily, and this isn't to challenge the UK's integrity of it, just saying that the approach is not, wait a minute, we need our UK auditors to have access to the working papers to be able to sign off as we would any other UK-based company. It sounds as if the need to attract and continue to have London as the financial hub in Europe is potentially at a minimum going to be a balancing act. And in a balancing act, you sometimes err on the side of something that in hindsight ends up looking as if you maybe didn't get the balance right. I'm not saying that's going to happen. I'm just saying as the UK is seeking to become the leader of, or to maintain its role as the leader, it's going to be forced into taking some of these decisions that are going to be balancing acts. And who knows where that ends up.
So I have a number of questions about clearing, and that's no surprise. Katharine, you also actually emphasized this issue in your initial remarks. 3 questions from people whose name have a common ring, including with me, Gilbert Sintès, Christian Chavagneux, and Damien Soé. And they're asking, essentially, you know, what will be the consequences of all this? Also, what will be the UK response? But one point which I'm really interested in having your perspective is how important is the whole issue. After all, the UK has downplayed the importance of the location of trading. We've seen the impact of the share trading obligation and the shift of a lot of that trading to Amsterdam. But the comment from the UK has been that's not so important because this is just, you know, where some computer is based, but that's not what drives the location of business. So why is clearing different? Why are there such inflated expectations of, for example, the number of jobs linked to this? Can you give us a bit more of a sense of the substance of what's at stake and not just the decision-making process?
Yeah, I mean, and certainly to go to the sort of what I would describe as the finance ministry part of that, which is jobs at stake. I don't understand all of the quite inflated statements about that where clearing is concerned. It's not a very employment dense activity. It's not a very tax revenue generative activity. That's not a criticism at all of clearing. We're very proud to have world leading clearing houses here in London, but the advantage is not that it's sort of some incredible cash cow for the Treasury. There are two I think there are two material concerns about clearing location. One is, why do you have these massive concentrations? Because of the compression benefits. So if you force disaggregation of clearing, then you drive cost into the distribution chain for financial services, and that directly affects the costs for corporates in particular as they try to fund themselves and manage their risks. And that's, you know, that's a concern. That's a concern for those of us focusing on the question of, you know, generally speaking, how the sector supports our economies as we, at least in the near term, seek to achieve escape velocity from the COVID shock. But the financial stability risks are different, and I think really quite serious compared to some of the other Brexit risks that we've talked about in recent years. And that's because any attempt, you know, the complexity of these very large open books in the very large central counterparties means that forcing the relocation of open positions is a really risky activity, and one that has not really been engaged in before. You need, it needs to be moving to a counterparty that can itself handle those positions. That's pretty complex. It takes some time. You can see that there would be a good deal of disruption and risk in the industry and in markets as you try to achieve that split, and I just have never seen a very clear explanation of how you could move open positions at scale in a way that is safe. I'm not saying it doesn't exist, I'm saying that I've never seen an explanation of how we might achieve it. And because of the commercial imperative that I describe, firms will only, clearing members will only choose to move their business really if the cost imperative makes that a sensible thing for them to do for their clients. So I think the concern comes where you're forcing relocation of activity where the commercial logic doesn't apply, and what the financial stability consequence of that is. I mean, we've seen the move of we've seen the shift of some euro denominated activity that I think makes perfect sense to move into the euro area. The question is, what about the rest? And that's not really, you asked about the response to the UK authorities, and in a sense we have to respond to the approach that European authorities take or choose not or decide not to take to try to give this policy some reality, and the outer edge of that looks quite concerning to us, but it's not, these aren't things over which we have a massive amount of control. The point at which it speaks to the stability and safety of our own CCPs, we will be extremely concerned to ensure that stability is supported. But more than that, I can't say, because it's just not terribly clear where this is going to go, to be.
Yeah, and do I understand you correctly? So you mentioned 2 points. One is the cost point compression benefit. The second one is financial stability. Did I understand you correctly? Is that your financial stability concern is primarily about the transition, or to which extent is it also?
Well, it could be about both, because it sort of depends what the. It depends what European institutions want to do to give effect to their stated goal. And that could end up with fragmentation that's worse for financial stability, but you've got to have a matched book. There's quite a lot of regulation about how CCPs are supposed to work to ensure that they're stable. I think forcing a transition in itself, however, raises quite a lot of financial stability and concerns. And as we've got close to these cliff edges in the past, those who've been close to this debate will know that the anxiety starts quite a long way out from the expiry of equivalence. Anxiety starts from the point at which CCPs have to start asking members to roll off their positions because of the risk that in 3 months they can't match the book. And it's that disruption in itself that I think is the first problem we would have to deal with.
Doug, on CCPs and central counterparties, and the clearing issue.
I don't think I have anything to add to that. I think I worry about what I said in the beginning, which is more of the tit for tat response function of the UK and the EU getting into more of a regulatory cycle that ends up being counterproductive, if not outright destructive, and accelerates some of the financial stability risks that Katharine is referring to. Without getting into the specifics, it's more just that level of, if the status quo is fine and you start to tinker with it, where does that lead? Any incremental move might not in and of itself be disruptive, but if it leads to a reaction, which leads to another reaction, these things have a way of getting out of hand. That's one of my concerns. Yeah,
we have also a point from Thomas Ray on convergence or divergence. The question, if you're not seeking convergence as a goal, which is what you told us, Katharine, I guess divergence is almost a given, right? Because you will have parallel decision-making processes which have no reason to end up in the exact same place. Or do I get that wrong?
No, I think that's right. I think the but we won't be operating wholly. I mean, we won't be operating in isolation. We can't operate in isolation. We have a good deal of shared interest, and we have concluded a memorandum of understanding about the kind of dialogue that we expect to have with each other, which I think will be probably the most engaged, the most frequent regulatory dialogue that we have with any partner, which you would expect given the scale of the shared interest. So I don't think we intend to just sort of plough our own furrow without caring about the impacts elsewhere. The reason I put it in those terms is, you know, in the last 2 years, 3 years, I've been asked over and over and over again, are you going to converge with or diverge from EU policy? Well, if you don't have an equivalence decision which is directly impacted by your regulatory decisions, that drops away as an objective in itself. It becomes a question, it becomes part of your policy analysis about the impacts of things that you might want to do, and we'll be addressing it. You know, that's the way it comes into our worldview, if that makes sense.
That's right. One question I have is your reaction to what Doug said about, you know, the impression that the UK government was kind of throwing the city under the bus, not really trying to prioritize it, despite the very significant impact, including in terms of tax revenue. I mean, you've been at the center of that for the last, since the Brexit referendum and before. How did you feel about all that? I mean, I'm not asking for comment about political decision making, but what can you share anything about your experience on, you know, how the city and financial services have featured in the whole Brexit negotiation sequence?
Yeah, so I think that's a surprisingly complex question to answer, because it was a pretty long and winding road to that agreement that included not one but two general elections. So we saw several, you know, goes at the way in which we might approach this in light of that political change. As I said at the beginning, this wasn't where we wanted to end up, and our first pitch was quite a developed approach on mutual recognition, which the EU had, it seemed to me, just no interest in pursuing whatsoever, because their position was, well, we have a way of dealing with access to the EU and its equivalents, and that's how it's going to work. So in a sense, this wasn't, I think it's, this is not purely a function of UK political priority. It's also a function of the EU response to an unlooked for problem, let's be honest, which is the UK's departure from the European Union and what that meant for financial services. If on the basis that the EU wants to use equivalence, well, that actually leaves you with some quite thin pickings in terms of how you approach a free trade agreement, because it does throw you much more into the regulatory space. And as I said, our goal there was to try and have quite a developed section of the free trade agreement that accompanied and supported a more, frankly, built out approach to how we might manage equivalence decisions. In that, we weren't successful, and we weren't successful for reasons as much to do with European policy priorities as to do with our own, to be perfectly frank. But it's also the case that the government's position was that British citizens had frankly had enough of this negotiation. They wanted us to conclude it, and they wanted us to deliver a negotiation that delivered the main things they were concerned about. So, it was a combination of those factors, I guess. But I certainly don't think it's as quite as simple as the government cared less about financial services than they did about fish. I think that's not quite what happened. You wouldn't be surprised to hear me say that, perhaps.
With all due respect to fish, there are questions from two questions about the transatlantic relationship in the sense of UK-US. One is from Greg Smith, who is asking how the financial sector in UK and other places. Sorry, no, I'm not taking the right one. So how will the Biden global tax on big firms have impact on financial destinations, and that will put pressure on transparency and accountability. So I maybe to both of you, how do you see the tax debate in the UK interfering, if at all, with these issues of financial sector competitiveness? There's also a question which is slightly different but related from Catherine Martin, What in your view are the issues on which the UK and the US can collaborate more successfully bilaterally and in international bodies? So let me bundle those two on US-UK. Katharine.
So to take the taxation point first, you will recall that at the last budget, the Chancellor increased corporation tax, which was a big deal. That's the first time that's occurred literally in my lifetime in this country. So, approximately 1 million years. And one of the things he said about that is that increase in corporation tax, if not adjusted for banks, would really make the tax position, particularly for international banks in the UK, very uncompetitive. So we're reviewing that specifically because we are aware that the overall tax burden is one of the things that affects location decisions for internationally mobile firms that provide the gravitational core of the UK's financial services system. As for a global tax, I mean, it feels to me as though there's quite a road to be travelled before that becomes a reality. So I think the focus for us in the near term is much more about not being the lowest tax environment for banks, but just making sure that it's not a reason that drives good business out of the UK's economy. In terms of the US bilateral relationship, we've had a very constructive relationship with our US counterparts under the last administration, as well as I'm sure we will do under this administration. I think the thing that we can really now get going on is environment and climate, where it's very hard to shift the dial on that in finance terms if you don't have the US at the table. We now need to understand how the US is going to approach these questions in sort of technical and regulatory and policy terms in order to understand what is deliverable. We are, without wishing to go on too long about it, I think in this climate and environment space, we're having to put in place the building blocks and the norms for markets that don't yet exist for internationally mobile liquidity that will ensure support for the transition of all our economies to net zero and address other climate and environment concerns. So that implies a certain degree of international convergence, and for international convergence to be real, we need to know where the US is coming into the debate. So I think that's very important. But I think also we have very productive discussions with the US in the sort of international standard setting environment associated with a conversation about fragmentation and about international norms, for example, around portfolio delegation, all of which have been sort of thrown into debate in recent years, and where I think we probably have quite a lot of common interest with the US. So I think all of those are going to be really productive in the next period for us.
Let me just weigh in and say, I think when you're looking at the US, on the broad array of issues involving international economic policy, I think that the two words that ought to be tattooed on your forehead have got to be climate and China. And that's not specific to US-UK relations. That's just a broad-based starting point for everything. So as Katharine mentioned on climate, I think that there's probably going to be a lot of areas where the US and the UK can cooperate. I'm more concerned about the relationship between the US and the UK when it comes to China. I think my fears were much worse or much more heightened before the debacle in Hong Kong, where the UK has, rightly, in my view, taken a more principled stance against China for how it has handled the Hong Kong situation, which has put a greater impediment to the UK having a closer relationship with China than might have otherwise been the case. But nevertheless, as I mentioned earlier, in pursuit of this competitiveness agenda, given the rising economic and financial heft of China, it's going to be a difficult balancing act for many countries, including the UK, in figuring out where the US is really seeking, if not to outright decouple, certainly to create a much more you're with us or against us mindset on some issues when it comes to China, where the UK is going to end up on that, not specifically to financial services, but certainly including financial services.
And that's an excellent hook for me to say that our next session on May 12 will be on Hong Kong as a financial center, and that will be with Douglas Arner and Lauren Gu. But before we close, I have two questions. One is technical but important, raised by Graham Bishop. And Graham is asking, will English law continue to be governing law of corporate bonds, and how will UK court judgments be enforceable in seizing collateral in the EU if there are defaults? I recognize Graham's sharp legal mind here. The other question, which is much more general, is to come back to this issue of competition, but not just with the European financial centers, also in terms of also competition with the US. So Rizal Linam is asking, wouldn't Ireland be better positioned to be as the Singapore of Europe than the UK? Maybe you want to answer this, but in terms of the US, Edward Green is asking, do you expect there to be any discussions with the US with respect to equivalency, and is New York likely to benefit from the ongoing uncertainty? Also, I have an anonymous attendee asking noting that the financial bill gives the prudential regulatory authority a horizontal objective of protecting the international competitiveness of the UK financial sector when drafting regulatory requirements. What does that mean in practice? So on all this, Katharine, over to you.
That's right. I mean, that was more than 2 questions. So I'm going to do my best, but each of those deserve probably a bit longer than I can give them. In terms of, I can't even remember what was the last one about the US. Oh, about New York. Yeah, I mean, I don't doubt. Look, yeah. I mean, New York. If we can't, I mean, this has been my argument in favour of a more cooperative approach with the union all along. Is the main beneficiary, if we fight over this like dogs over a bone, is that the beneficiaries are in New York. And if you're concerned about strategic autonomy, then that seems to me kind of a perverse outcome. But for obvious reasons, I'm not considered an authoritative interlocutor on that. With my European counterparts, and you know, who can blame them? On the in terms of, and you know, it's an interesting point on Ireland. I mean, I think the Irish authorities have, in the wake of the financial crisis, taken a very sensible approach in terms of, you know, thinking about the scale of their financial services sector to the scale of their economy. Very wise, in my view. We have a very good relationship with our counterparts and regulatory authorities there. In terms of UK law, I mean. You know, the contracts are written under the law that the counterparties agree. I think there is potentially a question about how that ends up being applied through systems outside the UK and the extent to which that's considered to be robust and reliable by counterparties. It's not, unfortunately, a problem over which I have much leverage, and it will be interesting to see if that is a problem that remains hypothetical or crystallizes, because opinions have differed about that quite profoundly in the last 5 or 6 years.
Doug, I ask the lawyer and you to conclude. We're slightly past our time, but final words.
Look, I'm not going to add anything that Katharine didn't just cover, and the specifics of application of English law, you know, remain to be seen. I think like to conclude with, you know, where we started, which is, I don't think anybody wanted to be here. I take note of Katharine's, you know, very astute observation that it's unfair to say that the UK government threw the financial sector under the bus. I don't think that's exactly what happened. And again, it's not as if it was fish versus banks, but in the end, we are where we are. And I'd just like to highlight, I don't think we know where we are. Meaning, I think that the COVID crisis has just created this completely artificial sense of you know, the theater that is not necessarily reflective of the underlying dynamics. We don't know. I think when we have this conversation again in 6 months, 9 months, 12 months, we might be in a very different place, because hopefully at that point we'll be through the COVID crisis and we'll get to focus on the Brexit crisis, which is hopefully not a crisis, but the Brexit dynamic. And I think that we might find that there's some surprises waiting for all of us.
We are where we are, and we don't know where that is. I think these are fitting words to conclude our session. Thanks so much to you, Doug. Thanks so much, especially to you, Katharine. I know you're very, very busy these days, so we particularly appreciate. This was, to me, a very enlightening session, and I'm extremely grateful. As I said, our next session on May 12 will be on Hong Kong. And on that note, very good rest of your day, wherever you are, to all our audience. Thank you very much.
Thanks so much. Thank you. Take care.
Thanks, Nicola. Thanks, Katharine.